A very good evening. I am Aftaan Abdul Khader from Third BCom. The topic I've chosen to present is mutual funds. So let's get started. Meaning and definition of mutual fund. A mutual fund is a common pool of money into which investors place their contributions that are to be invested in different types of securities in accordance with the stated objective. Mutual fund is a common pool of money which a lot of people contribute, and that money is invested in different securities according to their objective. So the definition of mutual fund: a mutual fund is a professionally managed investment scheme usually run by an asset management company that brings together a group of people and invests their money in stocks, bonds, and other securities. So next is mutual fund cycle. Mutual fund cycle. So this is the mutual fund cycle, and then the first step is investors pool their money with fund managers. These fund managers invest in securities on behalf of the investors. These securities in turn gives returns. These returns are passed back to the investors. This is the mutual fund cycle. So let's go to the next step. Types of mutual funds. Mutual funds can be divided into two types: by structure and by investment objective. In structure, they have open-ended mutual fund. Open-ended mutual fund is a collective investment scheme that can issue and redeem shares anytime. Anytime shares can be issued and redeemed. Okay, then investors will purchase shares from the fund directly itself rather than the existing shareholders. They'll buy shares from the fund itself rather than existing shareholders. And then next is closed-ended funds. Closed-ended fund is also a collective investment fund based on issuing a fixed number of shares which are redeemable from the fund. It has a fixed number. It is closed. It has only fixed number of shares which is redeemable. So next thing is interval funds. Interval fund is a fund where the fund house allows to purchase and sell units only during a particular pre-decided time period. Only during a particular time you can buy and sell those units of funds. So that is interval funds. So let's move on to the next one. By investment objective. Investment objective has 6 types. Those are the first one is growth fund. Growth fund, a mutual fund that invests in growth stock to maximum capital appreciation. This fund is made up of companies that can deliver higher returns to investors in short time. Growth funds basically it means emerging companies. They'll invest in emerging companies which will give high returns. High returns. So the next thing is income fund. Income fund is a fund whose goal is to provide an income from investment. It will provide an income from investment. It will make sure that there is an efficient flow of income from what they have invested. And these types of funds are organized by trusts and partnerships rather than corporate, because corporate won't give enough returns. So it will partnership and trust will make sure that there are efficient returns. So the next thing is balanced fund. Balanced fund contains a stock component, a bond component, and a money component. All together, put together, it's a mix of everything. It'll have a stock component, a bond component, and also sometimes money component also. And the funds stick to a relatively fixed mix of bonds and stock. It will consist of both stock and bond funds, and it is basically in between growth and income. Okay, the next thing is money market funds. Money market funds is an open-ended fund that invests in short-term debt securities such as U.S. Treasury bills and commercial paper. They'll invest in Treasury bills and commercial paper. It is maintained with the goal of maintaining a highly stable asset value through liquid investments. It will make sure that it's in liquid investments through high stable asset value while paying income to the investors as dividends. It will pay back its returns as dividends. Next is load funds. Load funds is also a mutual fund that comes with sales charge or commission. You'll have to pay sales charge or commission for that. Brokerage, basically it means brokerage. Investor pays to the broker or financial advisor or the investment advisor. He'll have to pay commission for that. No load funds. No load funds. In this fund, you don't need to pay any commission for the broker or the investment planner or for the financial planner. Okay, let's move on to the next slide. Advantages of mutual funds. Portfolio diversification. It enables him to hold a diversified investment portfolio even with a small amount of investment like 2000. When a person invests 2000, even the 2000 will be divided into small parts and it will be distributed among different shares. So it'll make sure that is portfolio diversification. Next is professional management. These mutual fund agents are really professional, and the management of these funds will be done with skills and a lot of experience. That's what it means by professional management. The investment management skills, along with the needed research into the available investment options ensure a much better return as compared to what an investor can manage on his own. These agents will make sure they'll invest in returns giving funds. So if an investor won't know about the market, but the agent will know about the market. So the agent will make sure there is proper management. So next thing is reduction in diversification of risk. The potential losses are also shared with the other investors. Since there are a lot of investors for one share, even the losses are being diversified and reduced, because everyone will take a part in the loss also. Okay, reduction of transaction costs. The investor has the benefit of economic of scale. The funds pay lesser costs because larger volumes, and it is passed on to the investors. There are no very less transaction costs is what they actually mean. The funds pay lesser cost because of larger volumes. People are there, so funds are also very less. So the transaction cost also will be less. Okay, the next advantage is wide choice to suit risk return profile. Investors can choose the fund based on their risk tolerance and expected returns. Investors have n number of choices. So they can select any one fund which is suitable for them. They can expect high returns and low risk. They can also take low risk and higher returns also. It's based on their choice. The next thing is liquidity. Investors may be unable to sell shares directly, easily, and quickly. When they invest in mutual funds, they can cash their investment anytime by selling the units to the fund if it is open-ended, and get instant value. Shares cannot be easily transferable, but in mutual funds, you can cash your investment to the fund itself if it is open-ended fund in its instant value. And investors can sell the unit in the market if it is closed funded. They can sell their units in the market if it is closed-ended funds. Convenience and flexibility. Investors can easily transfer their holdings from one scheme to another. Investors can easily transfer. It's very flexible and convenience from one scheme to another. If this scheme gives lower returns and you feel it's declining, you can change to another scheme which will give an upward direction income. Okay, so get updated market information. You can get updated market information and so on. Funds are also offer additional benefits like regular investment and regular withdrawal options. You can get every information about the scheme, and you will have a lot of withdrawal options in mutual funds. Transparency. Fund gives regular information to its investors on the value of the investments in addition to disclosure of portfolio held by their scheme, the proportion invested in each class of assets, and the fund manager's investment strategy and outlook. Everything is being told to the investor. The agent makes sure that he gets each and every updated information. Excuse me. The mutual fund agent make sure that investor gets updated with each and every information. That's what they mean by transparency. Okay, let's move on to the disadvantages of mutual funds. No control over costs. The investor pays investment management fees as long as he remains in the fund. He'll have to pay for the management of the funds. Any whatever happens to the fund, he'll have to pay. Even if it's declining, he'll have to pay the transaction fees, the management fees to the agent. Even when the value of his investments are declining, he also has to pay funds distribution charges, which he would not incur in direct investment. In direct investment, this is not incurred, but distribution charges will be incurred in mutual funds. That also he'll have to pay. No tailor-made portfolios. That is, a company will not have their shares in a number of shares in their own name. That is not possible in mutual funds, because a lot of investors will pool money for one share itself. So okay, next is managing a portfolio of funds. Availability of large number of funds can actually mean too much choices for the investor. A lot of funds are available, so a lot of choices also are there for the investor. So they'll get confused, and they might need frequent advices about where to invest and where not to invest. So that's managing a portfolio of funds. That's very tough in mutual funds. The next is delay in redemption. It takes 3 to 6 days of redemption of units and the money to flow back into the investor's account. Compared to shares, it will take compared to direct investments, it will take more time for the returns to come and fall in the investor's account. So next is some of the interesting facts about mutual fund. Equity instruments like shares are only a part of the securities held by mutual funds. Mutual funds also invest in debt securities, which are relatively much safer. Mutual funds do not invest in only equity instruments. It also invests in debt instruments, which has a lot of lesser risk and gives a lot of returns. Okay, mutual funds are there in India since 1964. So basically it's been more than 60 years in India. Mutual funds are there in US for more than 60 years. So that's a very good thing about mutual funds. Mutual funds are the best solution for people who want to manage risks and get good returns. It's very good for people who want lower risks and get good returns. It helps them to get good returns because the risk is very less. So next slide. The myths about mutual funds. Some of the rumors which are false. Okay, some of the information which are false about mutual funds. Let's talk about that. Mutual funds invest only in shares. No, they don't invest only in shares. They invest in a lot of security instruments. Okay, next. Mutual funds are prone to very high risks and actively traded. No, mutual funds are always highly traded, actively traded, I mean, sorry. It is actively traded regularly. It's been traded. Very high risks. There are mutual funds which have high risks also. There are a lot compared to the high risks funds. There are a lot of lower risks funds. Mutual funds are very new in the financial market. No, basically from the last slide you can see that it's more than 60 years in India. It's there for more than 60 years in India. So it's been very long. So it's quite old actually. Mutual funds are quite old. Mutual funds are not reliable and people are rarely invest in them. That's really that's not true actually, because you can always rely on mutual funds because the risks are always lower and a lot of people take care of your losses. It's been diversified and people rarely invest in them. That also is not true nowadays. Even MS Dhoni is coming in the ads for mutual funds because even he trusts. So people will surely invest in mutual funds. There are a lot of people already invested in mutual funds. The good thing about mutual funds is that you don't have to pay attention to them. That's not true. You have to pay attention to everything actually. So mutual funds also you need to pay attention periodically, maybe not very not in a short period. Maybe you'll have to check it out once in a week or something like that, just to make sure what's going on in the market. So okay, let's move on to the conclusion. So what I would like to conclude by saying is that while instruments like shares have high returns at a very high risk, and instruments like bank deposits have lower returns, but it gives higher safety to this investor. While when compared to these two, mutual funds have a balanced. It's balanced actually. It's between a balance between risk and return. You can get good returns at low risks also. You can have equal risks and equal returns also, and get more returns also. So I would say I would prefer mutual funds any day. So now, thank you, Dr. Amin, sir. It was a really wonderful opportunity. Actually, it really helped us, and I'm really inspired by your thoughts and activities and assignments, sir. Thank you very much. It's really helpful for us, sir. Thank you so much.